how are they a billionaire and how do they afford these yachts? And we'll just go with Elon Musk or Jeff Bezos. Jeff Bezos is a good example. He's got almost 13% equity still left in Amazon, and he's able to borrow money against his shares in that company. Okay, so listen to this. Debt is not taxable. So if he's able to borrow at a low interest rate against his Amazon stock, let's say he gets a loan for $100 million against his Amazon stock at 3 or 4% interest. There's no scheduled payments, and that collateral is there. The interest runs on that, and hopefully he's over collateralized, right? He's not going to take 100% against it because it could go down in value. But if you know an asset's going to appreciate, it would have been great if he had taken out loans against it when it was like 10, 15, 20, $100 even. He could have, paid it back by selling just a little bit of his stock later on. So, but he's able to take out those loans against that equity that he owns tax-free. So people complain about billionaires not paying their fair share. Well, they don't make money like you. As a W-2 employee, you are taxed and you have to pay Social Security, Medicare, Medicaid, and if you make over $300,000 a year, you're looking at 37.5% is what you're going to owe the U.S. government if you're paid as a W-2 employee. They play a different game. They take that capital, they invest. If you look at Mark Zuckerberg, he gets paid $1 per year as his W-2 income. Elon Musk is a little bit better than that. He pays himself $50,000 a year. And so if you understand the tax shelters and how this game is played, you can, and just want to point out also, there's a lot of millionaires that are made in real estate, but the majority, almost all of the billionaires that are made, it's in private equity. They own equity in a company that is $1 billion valuation or higher, and that's how they made their money, and they take loans against that. So same thing with the real estate though. You keep playing the debt game, right? So you acquire an asset, you get tenants, they pay it off over time, you're able to take out another HELOC or a loan against it, hopefully at a lower interest rate than what you originally financed the property at. And then you leverage that capital on another property, right? And you put down and take out debt on that asset, and then it appreciates in value over time because we have inflation, right? So assets continue to appreciate. So for the last 50 years, the people that have understood this game have gotten crazy rich doing this. Now, I'm not saying that this is going to persist into the future because we're at the low end of the yield curve on interest rates. We've just hiked back up now. Maybe we'll stabilize. We'll see what the Fed does if they are able to raise it anymore. I think they'll probably pivot, or maybe it stays here, at 5%, which you need for a healthy economy. But with the way that the financial system's worked in the past for the last 50 years, if you understood the debt game and that it wasn't taxable and you just took loans against your assets that continued to appreciate in value over time, you didn't sell them, so you didn't have to pay the capital gains tax, and you still had exposure to the assets while they continued to appreciate, you just became wealthier and wealthier and wealthier, right? So how does this apply to digital assets? Well, this is a completely brand new asset class, but the collateralized loans has already existed in this space. So we've had a lot of DeFi protocols. Some that you might know of will be like Compound or Aave, where you can collateralize your Ethereum and you can take loans against it. A lot of people did that and put their money in UST, Terra Luna, before it collapsed. I know multiple billionaires that made a bunch of money in Ethereum that didn't do so hot when all that happened because they had collateralized their Ethereum there and they were earning 20% yield on their money with UST, which isn't sustainable, and I told them that, but I digress. So, but that's the way to play this. So if you can take loans against your collateral at a low interest rate, say 3, 4, 5%, maybe even lower if it's U.S. Treasuries or it's a tier 1 asset in the banking system, and then you're able to take that capital and put it somewhere else where it generates a higher yield that's a cash flow, right? So maybe you're putting it somewhere where you earn, and maybe it's in a business where it's 50% APY that you make back on it on an annual basis, or maybe it's a passive investment where you're making somewhere between 10 and 12%. Okay, you can live off of the arbitrage there. So let's say you borrowed $100 million against your crypto at 3%. Okay, and then you were able to take that 100 million and you put it somewhere else where it generates 8%. It's conservative, it's a good investment, it's pretty safe. Maybe it's in real estate, right? You're getting an 8% APY, and that's as a passive investor with somebody else that you gave it to them. Maybe it's Grant Cardone, you put your money with Grant Cardone. I'm not advocating for him, and I'll just put the disclaimer in here. Nothing said here is financial advice. Always consult with your financial advisor, your CPA, or your attorney before making any financial, tax, or legal decisions. The information presented here is only for entertainment and educational purposes only. So anyway, you'll take that money at 3%, go put it somewhere else where you're making 8%, and you got a spread of 5% there. So you owe $3 million a year. That's your APY. That's what you owe on the interest rate where you took the loan. And you're making $8 million a year over here because you got 100 million, 8%, $8 million. That's $5 million a year that you continue to make with that capital, and you do pay tax on that. So I just want to make that clear. Any income that you receive, even if it's dividends, as passive income, is going to be taxed less than W-2 income because you're not going to have to pay Social Security, Medicare, and Medicaid, but you're still going to have tax implications. So hopefully you're doing this inside of an LLC where you've got expenses and you can offset that taxable income that's a pass-through entity. So you have an S corp, and the other stipulation there is you got to pay yourself a reasonable salary. So maybe you're paying yourself $50,000 a year W-2 that you are going to be taxed on, but the rest of it's distributions from the business, and you're also able to use the funds within the business to get all the write-offs to offset the tax obligations there. Maybe you buy a jet, like I've talked about in another video, right? So anyway, with the $5 million in interest that you're making off this investment, you buy the jet, you put $2 million down or $4 million down, you got an extra $1 million. Anyway, there's lots of different ways to skin this cat. But the point is, you're taking out a loan against your assets, which is not taxable, at a low interest rate. You're going to take that capital and deploy it through a business where you're going to make a higher return for whatever that is. And then you live off the arbitrage, and you can pay that other 3% back to the note every year and take your capital back out if you need to, or just let it ride, right? That's what most of them do. And as the asset continues to appreciate in value over time, it takes less and less and less of that asset to pay back the original loan that you took out. So like I talked about with the Amazon stock, let's say Jeff Bezos started taking out loans against his Amazon stock at like $100. Okay, well, now there's been multiple stock splits and it went up to 4,000 before, I know at least once before they split it. So, I mean, so let's just say it went to the 4,000. It's 40x on his money since then. So now it takes 1/40th, even if he took out everything he could at $100, it's 40x from then. So he could sell 1/40th of what he owns in the stock and pay back the loan, and that's also a tax write-off because he's paying off his debt. It's an expense. So that's how the wealthy use this stuff, and that's why assets are the best way to go. Ideally, obviously, you want assets that produce cash value, but you always want to be able to take leverage against them.